Good afternoon, everyone. Today, I'd like to take you through a recap of one of the topics that we have dealt with this semester, financial statements. As you know, it is a requirement according to International Accounting Standard number 1, presentation of financial statements, that all registered companies should produce a full set of financial statements. And if you have read the Wall Street Journal this week on Thursday, the 2nd of October, it had an article whereby the oversight body, the Public Companies Accounting Oversight Body, has approved for any audit firm that is going to be conducting more than 200 audits a year and has got more than 1,000 auditors to publish their financials every year. This is in a bid to aid transparency, because as you know, these financial statements, they are meant to give information to the public, and the public use this information for decision-making purposes. And if the right information is not communicated, it can actually lead to the public making the wrong decisions. Therefore, it is very important and vital for organizations to report their financial statements the proper way. Therefore, let's dive into this topic. We have got quite a number of financial statements that are required according to IAS 1. The first one that I'm going to talk about is the statement of comprehensive income. This is what we formally use to call the profit and loss account. Then the second one is the statement of financial position, formerly known as the balance sheet. Thirdly, I would like to talk about the statement of changes in equity. And after that, I will talk about the statement of cash flows. And lastly, I would like to talk about the notes to these financial statements. So as you see, these statements are the ones that make up a full set of financial statements according to International Accounting Standard number 1. An income statement or statement of comprehensive income, it is a financial statement which shows the performance of an entity over a period, a given period, which could be a month, 6 months, or a year. You'll find that the statement of comprehensive income is prepared for a specific period. Let's say for the month of August, for the year 2023, and so on and so on. This is where the organization calculates whether its operations during that period resulted in a profit or a loss. Secondly, I would like to talk about the statement of financial position. As opposed to the income statement, the statement of financial position is prepared at a specific point in time. For example, it is prepared at a specific date. The financial position of an organization is reflected in the assets, capital, and liabilities of the organization. This financial statement shows the capital that was employed by the owners of the business in terms of equity, plus the additional capital that was sourced from lenders in terms of liabilities. And then the other leg of the statement of financial position will then show how this capital was employed or how it was used in the business. It is then reflected in terms of assets that were acquired with the purpose of using these assets to generate revenue for the business. Therefore, you would find that the statement of financial position is actually a reflection of the accounting equation, which should always balance in terms of assets being equal to capital plus liabilities. The third statement that I'm going to talk about is the statement of cash flows. This is also one of the most important financial statements, as you realize that when we are preparing the statement of comprehensive income, we use what we call the accruals concept. The accruals concept allows us to consider items like prepaid expenses, prepaid revenues, which are expenses that we have incurred, but probably we have not paid for them, incomes that we have earned during the year or the period, but probably we have not yet received that income. But as we prepare our income statement, we consider all these items in our generation of profit or loss. However, when we are preparing the statement of cash flows, a cash flow statement only considers items that involve the actual movement of cash and cash equivalents. Therefore, it disregards items like depreciation, prepaid incomes, and prepaid expenses. It becomes very important in business to have a cash flow statement because we find that at times we could be having our creditors that we are owing money, and if they decide to just come and demand their dues at once, at times the organization may fail to settle these obligations. Why? Because some of the reported profits that were reported in the statement of comprehensive income are including monies that are still owed by our debtors. We have made credit sales, but in actual instance, we have not received the actual payment from the debtors. The income statement would have included that as part of their sales. However, the cash flow statement will only show the actual cash receipts and cash disbursements that have been received by the organization. And more than not, it reflects the actual position that is reflected in our bank statement as the actual cash at hand. The fourth financial statement that I'll be talking about is the statement of changes in equity. This financial statement is more of a statement meant to serve our investors, the owners of the business, those people who have put in their money into the business. They are interested in seeing how their investment is growing. So it reflects whether the business has generated more revenue, which will then result in their dividends and their investment in the business growing. And lastly, on the set of financial statements, I'll talk about the notes to the financial statements. The notes aid to the financial statements. They give some explanations of the policies, concepts, and other policies and procedures that may have been used during the preparation of these financial statements. To non-accountants, it can be very difficult to interpret some of the figures without the aid of the notes. So the notes, they give an explanation as to why an entity has used a certain policy, why there is a difference from the previous year to the other year, and that can be explained in a change of policy or probably a concept that was used to derive those figures. Therefore, as you realize that each and every registered company is required by law, it's a requirement that they should always publish these financial statements annually. It is very important in terms of informing our stakeholders, who can include the investors, the public in general, government and government agencies, and even potential investors. They look at these financial statements and make, deductions which will inform their decision making, whether to engage with the company or to disengage. Therefore, it becomes of paramount importance that these financial statements are prepared without errors and are a true reflection of the performance of the organization. I submit.